Why am I not hearing you, Mr. Jeb?
It's because I have the mute on. That's why. Hey guys, happy Wednesday. Welcome back to another week of the Educated Homebuyer Live. This is with Josh and myself to answer your mortgage and real estate questions while updating you on the economy, everything that's happening with mortgage rates, house prices, inventory, buyer demand, all that good stuff. And today, Josh, we got some news from the Fed.
We heard from the Fed. I don't know if we got news. We heard from the Fed.
And hence the name of the episode, the idea that interest rates are probably going to stay a little bit higher for longer. There's a lot of uncertainty out there in the market. There's a lot of unknowns with tariffs that impact what that looks like. And we're going to talk about it as we dive into tonight's episode. But do us a favor. Let us know where you're watching from. Start putting your questions in the chat so that as we're done with that, we can just jump right into them. Anything you want to get off your chest tonight, Josh?
No, but we're going to try and share a video later, and so I can show you something amazing that happened on my golf trip. Have you ever seen a herd of 100 bighorn sheep come through your round of golf?
I haven't seen or heard. I've seen like 5 or 6, and I know they sound like a stampede. So it's
we looked over and I'm like, oh, look at that. There's like 10 bighorn over there. No, like a whole herd of them just comes cruising through. They were eating flowers. They liked the flowers on the golf course.
Good stuff. Good stuff. All right. So let's take a look, as we always do, and start with inventory, where inventory is continuing to increase. We're sitting at 33% higher than just a year ago, 744,000 unsold single-family homes on the market at this point. We mentioned it last week, but this week we are officially above where we were in 2020 with regards to inventory. You'll see here as we pair through this, we went from 728,000 up to 744,000. Again, we surpassed last year at this point, and so this is the highest level we've been in 5 years. My guess is, Josh, we're going to continue to see it grow here for the next couple of weeks, right? We still haven't seen the peak in inventory quite yet, and my guess is, depending on what happens with rates, could be a little bit later in the year. Active inventory. So this came from Calculated Risk. These reports come in from these different areas, and then he, aggregates the data and puts it out. So it's a couple of weeks old on some of this stuff, but active inventory, I put this up here. Most of the markets, when you're looking at this, compared to year over year, we're up considerably. But when you compare it back to 2019, you still have Las Vegas is still under inventory levels. You got Raleigh, San Diego still under those inventory levels as well, whereas markets like Charlotte, Denver, Nashville, the Northwest as a whole, Portland have seen an increase back over those 2019 levels. Active inventory here in Orange County, 2.5% higher than it was last week, sitting at 4,363 homes. Huntington Beach, we're actually down a little bit, about 2.5%, down to 286 properties. Again, I think both of these markets are going to continue to see inventory coming soon. I personally have 4 listings coming to the market in the next 10 days, and then another 3 that'll probably hit the market in the next 60 days. So I know there's inventory out there. There's sellers looking to do things for various reasons. And, I think that inventory, those numbers are going to build, Josh, because I don't think they're being met with buyer demand just because rates are a little bit higher than where most buyers want to see them.
Well, are you speaking more in terms of nationally, locally, what you're seeing?
Nationally. Yeah, nationally, even locally too. I see it happening. I mean, inventory, I don't think inventory is going to, there's more, inventory supply is exceeding demand at the moment. So those inventory numbers aren't going to go the other way.
I don't disagree with that, but let me throw this out at you. This is anecdotal. So for all of you watching at home, take this for what it's worth. Most of the clients, the buyers that I'm dealing with, are semi-particular in what they're buying. So like we talk about the nicer homes, the upgraded homes, the things that are turnkey. I don't have a lot of buyers that are going in and not having any competition or just rolling in and getting their offer. It's happening, but I would say probably 2 to 1 where they're going in with 1 or more other offers on the property. You think that's more a function of people still preferring the more turnkey, nicer homes, even though there's more inventory out there to pick from?
I do. Yeah, I think that's the case. I mean, I think we work with a lot of buyers who they have the money for the down payment. They don't necessarily have the money for the remodel. They don't have the money built up to really have the house that they want to make it, if you will. So they need to buy it already remodeled, and therefore those properties, when they're priced correctly, still get a lot of activity. And I'm seeing that personally, and I think that's going to continue to increase or continue to happen just because of that. I think it's relative, right? You have to understand at what price point are these homes coming on the market. You know, in our market, under 1.5 is still a pretty competitive price point. Crazy enough. I mean, I know for a lot of part of the country, that seems crazy, but here locally where we are, that's a starter home in many ways. And so, you know, depending on where you are in the country, if your starter home is 400,000 and the inventory that's coming on the market is 6, 7, 800,000, then you might see inventory grow a little bit. Whereas if it comes on in the price points where the majority of buyers are, then, you know, it's probably going to continue to move if it's priced right. So I think that's what we're going to see more of. But, you know, it's, you don't know what you don't know, right? And at the moment, a lot of unknowns out there. This said, new listings, 78,000 new listings unsold, which was 12% more than last year. But still fewer sellers than many out there are expecting. Why? Not sure. They were expecting over 80 something thousand this week. In some of the data that I was looking at, the number came in slightly less. Is it because of Easter? Some of this delay, we don't really know. Are people waiting for lower rates to list their homes? Could be some of that as well. I just, you know, we're getting back to more traditional markets where we're not just going in this one straight line. There's a little bit of ebb and flow to the market, and we're starting to feel it a little bit. Let's see here. And that's going to take us into calculated risk again, kind of looking at that new listings chart. You can see here, Charlotte is the one market that they're looking at here who actually has new listings back to 2019 levels. The other markets, Denver, Las Vegas, the Northwest, Portland, Raleigh, San Diego, inventory still, or new listings compared to 2019, still relatively low in that time compared to 2019. Here we look at weekly pending home sales. So when we're looking at weekly pending home sales, 71,000 home sale contracts, that's up for the week, but 8.7% below last year. Condo sales were 19% fewer than last year at this time. And I think that's probably because of all the craziness out there with insurance and HOAs and all that good stuff, Josh. And then we look at home prices. This is the one chart that's really hard to nail down what data he's looking at, as we mentioned last week. But this is the median price of weekly pending home sales. So this is the weekly information, but it's the median price of this week's pending home sales was $395,000. That's less than the same week compared in 2024. It's the first negative year-over-year reading since back in 2023. He goes on to say that 1 week's not a trend, but we have to continue watching it. And then price cuts, right? Almost 37% of homes on the market have some sort of price cut. Just a function of what's happening out there in the market. 10-year Treasury, Mr. Lewis. What's happening with our 10-year Treasury? The tail that wags the dog.
I actually meant to put this as the slide after this, but let's start here. So the green line there is this is just today's chart. So I always like to show what happens on Fed Day. How did the market react? So the green line is the announcement at 11. And then 15, 20 minutes later, you start the Q&A. And the Q&A, you saw a little knee-jerk reaction. We went from a drop. These are all minuscule differences. Like we started the morning at 433. By the time they make the announcement, you're at 429, 4 basis points, not a huge difference, but then another couple quick basis point drop. And then we're back up over 429. And that was a function of, I believe, Powell basically coming out and saying that both unemployment and inflation risks to the upside have increased recently. And the markets didn't like it, but then you can see by the end of the day, they went through, it wasn't that big of a deal. So let's look and see, what did he say? Says, can't say how long it will take. We'll know more with each week and month where the tariffs are going to land. We won't make progress on goals this year if the tariffs stay. On that front, Jeb, today we saw, I think it was this weekend, we are China and our trade, whoever's the negotiating, they're meeting somewhere in Europe to hopefully make some progress this week, because we won't make progress on goals this year if tariffs stay. When things develop, we can move quickly if appropriate. So when things develop, what's he talking about? Something happening with inflation turning around and going the wrong direction, or unemployment jumping. We would see a delay on getting the goals for the next year. I can't confidently say I know the appropriate rate path. And that's about right. What have we said? They're gonna lay out, because it's hard to say. We have a delay here on what is going to happen, when it's going to happen, and how the markets are going to react. So he was asked about March projections for 2 rate cuts, and he says can't make a projection now. Wait until June. So you look at that. Even June, the markets aren't expecting much. Depending on the way things play out, we could have rate cuts or holding where we are. So not really talking about increasing rates. So that seems to be off the table. Either we're looking at sideways or some cuts later in the year. The last one, Jeb, was my favorite one of the day. In a blinding flash of the obvious, he said they could have tapered QE earlier or faster in hindsight. So in 2022, a full 2 years after the pandemic, they could have not been buying mortgage-backed securities. So thank you, Mr. Powell, for sharing that information with us. We wouldn't have otherwise known. So here's the projections. We have a June meeting, 80% chance of no cut. The July meeting right now, the market's thinking 82% chance we do get a cut. And then about a 2/3 chance at one of the next 2 meetings, we get another, and a 90% chance by the end of the year. So 1, 2, 3 cuts sort of priced in by the market. But as you guys know, that's a moving target. Ask, in another month or 2, once we know what's happening with tariffs. We just talked about the Fed talking about unemployment and what happens. The risks are weighted more towards the upside. Here's their projection for the end of the year, which is up at like 4.4%, which they increased that at the last meeting when they did their dot plots and they put out this information. They increased their expectations for later in the year. Some of the reports that we've seen, we just had the jobs report, Jeb, last Friday, and didn't see really any indication of a softening. But a lot of the other reports, JOLTS, the weekly reports, ADP came in weaker, other things indicating that there may be some weakness. And not that 4.4 is a weak economy or a weak jobs market, but definitely when you're back in 2022 down at 3.4, 3.5, it's a significant change in the number. This one, Jeb, before we even talk about this, I didn't really have a chart for it, but I don't know if you saw the apartment list numbers came out, and on a seasonally adjusted basis, rents were down 0.3%. In a real world, they're up like 0.5%. But when you seasonally adjust it, this is the time for renewals in the spring, and they're usually going up. Seasonally adjusted, they were down 0.3%. If you were to factor in the actual numbers for rents right now, we, over the last 12 months, not right now, not today, not over the last 90 days, over the last 12 months, inflation has been under 2% if you had the real world numbers of what's happening versus the lagged CPI figures for housing and inflation. So when we look at it, absent tariffs and potential inflation from those tariffs, we are very, very close to the 2% objective in inflation. This is another piece of it. We talk about oil. Oil's been under $60 a barrel. And all this chart shows you is that under $60 a barrel, you can't in the US profitably drill for oil. So one of Trump's promises was, we're going to drill, and that's going to drive oil prices down. Well, now we've already driven it down enough where it's not economically viable. But that tells us that that is a drag on inflation. It's pulling inflation lower and not likely to change in the near-term future. OPEC over the weekend just announced they're increasing production. So for whatever reason, cheap oil looks like it's here to stay. Jeb, I threw this in here just because I thought it was interesting. This is a little bit of a preview of that episode we're going to record here in the next week or 2. Lance Lambert over at Resi Club. This is 30-year changes in statewide home prices. The thing that I thought was really interesting about it, Jeb, is if you're in Florida, if you're in California, if you're in the Northeast, it doesn't shock you that home prices are up 300 to 400% over the last 30 years. But there are some states, if you're in New Mexico, Louisiana, Alabama, Mississippi, even Tennessee, which has benefited a lot. They're at 292, but some of the Midwest, less than 200%. So it was interesting to see that has not played out evenly across the country over the last 30 years. This one I wanted to show here, Jeb, if this chart shows what over those same 30 years, what's happened to total personal income, and it's gone pretty much straight in line with home prices, both up about 300% over that timeline. US rents only up 176%. But I threw that red arrow in. If you go back 10 years to 2015, you could see how much home prices were above in terms of those gains in terms of rents. But over that time frame, you've already now seen rents up appreciated above where they were 10 years ago. So that's what we're talking about. Even in the short run, if owning a home is more expensive today, give it 10 years with 3% inflation, 3% home price appreciation, you're not looking at that same situation. This, Jeb, is the big chart of the 10-year, not just the daily that we were looking at. Still sideways in that sideways channel there. The two yellow bands have not got back down in that down channel. So for the foreseeable future, until we get some clarity on tariffs and what's happening there with the economy, I think it's pretty reasonable to think that rates are going to just trend sideways somewhere, probably 6.5, 6.625 on the best level and 6.875 to 7% on the worst level. And that's shows you we're still near the higher end of that range. 6.86 on a 30-year conventional, 6.25 on FHA and VA. As usual, well-qualified borrowers can do a little bit better than that, but gives you an idea of where everything's at for now.
All right. So here we are. Not a lot of questions in the chat at the moment. If you have questions, start putting them in there. Let us know where you're watching from as well. That's also helpful. We've got M93 in Statesville, North Carolina. I know where that is. We've got Mackay in Knoxville, Tennessee, Dixieland in Minnesota. And that's all the people are telling us, Josh, not telling us anything else. They're keeping it close to the vest here. But we do have a question from Steve. Steve says, President needs a rate cut for his economic supply side of his economic plan, and consumer or market and consumer, periods help.
They do help.
I'm not an English major by any means, but periods help put sentences together. Structure. Market and consumer are demanding rate cuts. When they do happen, do you see them happening more rapidly than projected? So I think there's a world where the Fed gets too far behind. I don't see it at the moment. I think they're kind of in a good spot, right? I mean, the economy seems to be growing. Employment seems to be stable, at least looking at current numbers. And they're somewhat hesitant in that regard. Could they cut now? Sure, I think they could. I don't know that it would even have a real impact on the market, to be completely honest. But the Fed has a history of going too far and then going too far on the other side, delaying. And so could that happen? Absolutely. Too far out at the moment to know.
I just think looking at cause and effect, no one in terms of interest rates cares what the president wants or needs, and no one cares what markets want or need. The market is going to do what the market on a day-to-day basis thinks is accurate. So we saw the Fed cut a bunch in the fall, and Treasury yields went up.
Yep.
So if they gave into presidential pressure from the markets, pressure from anyone other than the actual economic fundamentals underlying that, cool. So we have Fed cuts, but we don't see rate cuts because the market is going to do what they are seeing is needed in the market, and that's based off of the return on money. So anyone that's going to invest in loaning money to the government or loaning money to mortgage borrowers is going to want a yield, and that yield is above and beyond the rate of inflation. So right now, the uncertainty of higher inflation based off of tariffs is what's keeping rates a little bit higher than what they otherwise would be. The market's underlying in terms of traders in bonds would have already brought rates down some. Who knows how much? It's an alternate world that we don't know. In dealing with tariffs and everything where they are actually today, the market goes, hey, I don't know what comes next. So we're just those two yellow bands, we're just chopping around in between there until they get some certainty. But what the Fed does and who pressures them to do it has very little to do with what we're going to see in interest rates.
There you go. A couple more coming in. Heather in Inglewood, Cleburne in Little Rock. We got Hand Me Down Clown. Hand-me-down clown in Bellflower, Cali Kid in El Paso. Steve came back, said he was only allocated so many characters. So that's fair. That's fair. I understand. So here we go. We got another question from Hand-me-down clown. It says, in escrow with a house in Bellflower that was a flip, seller refuses to pay for termites. In your experience, what is a worst case scenario for how bad termites can be? So here's the deal. Regardless of whether they pay for termites or not, you should have an inspection report and you should know what that looks like, right? So you could have, when you wrote your contract to purchase that home, you could have written it two ways. You could have asked the seller to pay for a termite inspection report and provide that to you as part of their disclosures, which is honestly pretty standard. Or the other option is you can do your own termite inspection during that due diligence period, and you'll know exactly what it looks like. It really irks me when people flip properties and they don't do the basics like termite work. That would be an easy deal to do. Like if you're flipping a home, you do the termite work. So I don't want to say that you should read into that, but if they're not doing the termite, what else aren't they doing? But taking this, I've seen properties that I didn't think were bad when it came to termites, and it was $8,000 to tent the property, do the woodwork and all that stuff. I've seen properties that look like they need a ton, and it wasn't as expensive as I thought it was. So, but understand that these contractors, to tent a property, that's not the expensive part. $2,000 or so, give or take a little bit there, to do the tenting on a single family home. It's obviously the size matters, but if I'm thinking Bellflower, probably a smaller home. But if it's woodwork, these guys are expensive right now. They're all busy. They're charging a lot of money. It can get really expensive. So I would make sure I did that, so I know exactly what I'm looking at. Just my 2 cents there.
When I look at it, I would be more concerned with it on a flip, because it is really, really easy to put drywall back over something that clearly needs to be fixed. It's not ethical, it's not right, but there are people out there that do not care. They're like, cool, put some new wall board up and put some tile over it, and no one's ever going to know what's behind that wall. And in that, so have that, Jeb said 100% correct, have the termite inspection. They're not going to do a destructive inspection. They're not opening those walls up. I've flipped over 40 homes, and you'd be shocked some of the things you find behind the walls, things that you have no reason to believe are there until you open a wall up, especially in kitchens and bathrooms where there could have been water damage, not just termite stuff, but water damage gets back there, and no one even knows about it. It's not that someone's trying to hide it from you, unless they did a renovation and didn't replace the framing that needed to be replaced.
Yeah, good stuff. And again, I'm not your real estate agent. I am a real estate agent. And if you don't have a real estate agent, I would love the opportunity to help. But no, in all seriousness, I can't really give you advice. But if Josh asked me this question, I would tell Josh to negotiate. Like, if they don't want to pay it, keep negotiating. Somebody's going to ask for the same thing, right? You're not in a market where, sellers still have some control, but it's not the market from 2-3 years ago. Negotiate it how your realtor seems fit to do so, but I would be aggressive. Scratchy says, hey guys, I see the inventory is piling up here in Phoenix. In your experience, can you negotiate the base price with new builders? What is the base price? Yeah, I mean, you can negotiate anything, but Josh and I have talked about this several times. Builders try to keep the base price or keep the price of the property up in order to protect the comps in the area and even new phases and new developments and that sort of thing. How they offset that, though, is by giving you credits, by giving you incentives, buying down your interest rate, builder upgrades, that sort of thing, right? They do these different things in order to, soften the blow, if you will, on new construction, but rarely ever are they negotiating anything major on the base price. But that said, I do have a client that's selling their home here in Huntington Beach, and they're actually looking in that Phoenix market, and more Scottsdale than Phoenix. And I asked him, I said, what are you seeing? He goes, we're watching, basically, there's a couple of different markets they're following, but he said that they're looking at where properties list and where they close. And he said, we're seeing a lot of properties that are 100,000 close less than where homes were listed. So depending on where you're looking, they're selling here for 1,350, so 1,350. I didn't ask where their price point was out there, but I have to guess probably 700 to 100 to a million, probably somewhere in that ballpark.
I mean, not that $100,000 isn't significant off of $1 million
No,
home, but it's wild off of a $500,000 or $600,000.
Oh, absolutely. Absolutely. Tom, what of the
9 trillion.
Oh, there you go. What of the 9 trillion that'll need to be refinanced by year end? What of the 9 trillion?
Let's look at it this way.
Yeah.
There is nothing that you saw on the news that people who do this for a living and trade those markets haven't looked far ahead and seen. All supply that is coming in the future is pretty well known. Each month, or it's quarterly, we get reports on the quarterly refunding, meaning what do they have to roll over? And no one is shocked by that. So if something was coming between now and the end of the year that was going to just blow the market away, it doesn't come out of the blue. It already would be priced in and you would have already seen rates back up.
There you go. Hand me down comes back in just and says, great, thanks guys. My realtor shared your sentiment. We received a credit for the fix, so good job there. The seller would not allow us to complete work during escrow. Is this typical? I would say it's not typical. I would say more often than not, sellers will allow you to do it, especially if the property's vacant. So if it's a flip, my guess is it's vacant. If it's occupied, then I can see where they wouldn't want you to do it just because of them living there and having to move out, that sort of thing. But after contingencies are removed and they know that you're moving forward on the property, I wouldn't see any reason why they wouldn't allow you to do it unless there's furniture from staging or something like that in there that they just haven't been able to get out. In which case, you don't want to, fumigate if that's what's taking place with stagers, furniture, and that sort of thing in there. So, and that way I see it, but I would say more often than not, we're able to get it done during the process, assuming there's an opportunity and the property's vacant. Let's see here. Sean is asking, do you think the unemployment rate is real? He's in Los Angeles.
I do not think that the government is cooking the books. I think their methodology is we just got the May jobs report last week, right?
Yep.
And surprise to the upside, 177,000 jobs created. Well, we had 58,000 revisions downwards for the 2 prior months, 15,000 for March, and February was down, or March down 43, February down 15. So what I believe is next month we're going to get revisions, and 177 was actually the 120 or so that the market was expecting. And even those revisions are probably not large enough. They do come back and do that QCEW a year later. We'll find out that that was probably overstated. So do I believe the numbers are real and accurate right now? I don't. But they follow the methodology that we've always followed. No one is sitting there with their thumb on the scale trying to change the numbers. It's just the way they calculate it and the way that it's always been done. Just like we were talking about, inflation is at or below 2% right now. If we could, accurately forecast current home housing inflation, but that's not the way it's always been done. You got to go with the way that it's always been done. So could we be less? I don't think we're negative on jobs creation. 177,000, 120,000, 99,000 is not robust job creation. Yeah. You're still expanding. You don't have an unemployment rate skyrocketing, but it's not what you would call robust anyway. You cut it and it is likely to be revised down.
All right, good stuff. I want to take a second here and just, thank you guys for being here. Thank you guys for continuing to show up. If you find any value, do us a favor, hit that thumbs up. Share us with somebody that is in the home buying process that might not have found our channel. I mean, we get people reaching out to the Educated Home Buyer podcast all the time going, God, I wish I would have found you guys 6 months ago. Or now we're in escrow on a home. It's like, we've been here the whole time. Why aren't we being found? So, if you find any value in the content, check out the Educated Home Buyer YouTube channel, check out the podcast, share it with somebody that's looking. That's really the best thing that you can do for us. And then, when we're here, comment, like, and subscribe, all that good stuff. And then if you want to get in touch with Josh or myself, you can do so using that link scrolling the bottom of the screen. And, we are here to help. We don't just provide education. We're not just talking heads. We actually sell homes and do loans. And I think, we need to make that very, very clear. So that's where we're at. Alex, new build in Salina. That is just north of Dallas, Josh, if you weren't familiar. Originally
It's
listed for.
Salina, my friend. Salina. You want to sound like a Texan? It's Salina. I promise.
I don't want to sound like a
It's
Texan. I want to
Salina.
sound like a Californian. I actually don't want to sound like Californian either. I'd like to sound, um, I don't know what I'd like to sound like, Josh, but neither of those. So we're going to Salina. I don't know how that, but sure. Salina, originally listed for 700,000. Final price was 615. Wow, plus $11,000 in total concessions. Definitely some opportunities out there. So congratulations, Alex. That seems like a pretty awesome deal there, man.
And let's say this, Jeb. You and I have
Almost
talked about
100
all the
grand
time.
off.
Builders, that is their last resort.
Sure.
They will want to give you free stuff, buy your interest rate down, put gold-plated countertops in. But it doesn't mean that it doesn't happen. At a certain point, the market dictates at what price homes will move. So when you see this, it is truly a last resort because they will try to do everything to keep the prices up as much as possible.
Absolutely, they will. Bleed Green, $10 super chat. So thank you for that. Appreciate you being here, asking questions. Says, I keep hearing that you should only put 3.5% down on a home, then wait 30 days and put a bigger down payment down, and you will save on payment and mortgage. And I think that's awful advice. But Josh, what are your thoughts on that?
Whoever you hear this from, stop listening to them. And if they talk to you regularly, tell them to stop talking. There's no world in which taking a larger loan
Terrible.
saves you money. So if you put more down, so 3.5, we're generally talking about FHA. If you have 5% to put down, 5% down will get you 0.05% lower mortgage insurance. It's not going to change the rate. That's a nominal change there, but you're going to have a smaller loan also. So it's going to be better. If you have more and you can put 10% down, an FHA loan with 10% down, eventually the mortgage insurance will go away. Less than 10% down, the mortgage insurance never goes away. So again, anyone making these suggestions is either insane or dumb or both. So ignore them and tell them not to talk in your presence anymore.
Yeah, and use that link, scroll in the bottom there, and you can get in touch with Josh and the team over here, and can walk you through the numbers rather. JM putting 20% down, closing mid-June. Builders lender, they're offering a 7% interest rate with $15,000. I guess for a buy down, if you will. What are your thoughts on that, Josh? And how about locking? So June is what? Wow, that's only a month away, dude. That's crazy.
Yeah.
But yeah,
With 20% down and a good credit score, that rate should be below 7%, should be well below 7%. So what I would do is I would talk to an outside lender. If it's a big national builder, they are going to stick to their guns and they will not do anything about letting you use an outside lender. But if you have a legitimate real loan estimate from an outside lender and say, these are the market numbers. So rather than you paying your buddies over there $15,000 to give me an above market interest rate, this is what I would like to do. And again, it's a negotiation just like everything else. So if you are in one of these softer markets, they don't want to lose the transaction. So I certainly wouldn't take a higher interest rate. A lot of that stuff is smoke and mirrors. Let's say it's a $700,000 loan and you're 0.5% above where it should be. Now you're looking at basically break even in terms of that $15,000. And I don't know about you, it's 6 of one, half dozen of the other. If you take their 15,000 and get the 6.5 that you should have got if you picked the lender that you wanted to work with, I just don't like being. I need to put like a little pony wall over there. I just don't like being manipulated, being told, "Hey, I'm giving you $15,000," when really all you're doing is giving me the rate that I could have, would have, should have got anywhere else.
good stuff. While Josh goes and turns off his light because he's once again he refuses.
I'm going to leave it on for your benefit.
He refuses to listen and take the timer off, and so here we are. But anyhow,
I'm going to let you take the timer off because I have the fancy little switch for my blinds over there, and that's a monster pain in the ass to get back on.
Well, there I can help you. I didn't say I could do that. I said I could help you take the timer off. Jamal is asking a question: is there anything on the horizon that would tighten lending standards, Josh?
From a VA loan perspective, Jamal's looking. We've had him pre-approved for quite some time. With the VA loan, nothing is going to appreciably change their guidelines. They don't move with the market. They have time-tested underwriting guidelines that they're quite confident will stand the test of time.
How about in general, conventional FHA? Anything that's out there that's worrisome?
You're constantly seeing little revisions, like more so than what you see in the guidelines. You'll see black box changes, meaning that things that would get approved 6 months ago through the automated underwriting now won't. So you could see little tightening around the edges, but nothing they see. So, like even going back in time, 2008, the biggest drop in the history of the world, like what you see then is investors going, not so much Fannie and Freddie, but they would add a couple of changes: a market conditions addendum to the appraisal that says, hey, what's happening? Cool, that's the value today, but what's happening? What's the trajectory of prices? You could have lower loan to value, but for the most part, even through the downturn, Fannie, Freddie, FHA, VA stayed basically the same. They tightened up some, and we've gone on and on and on here. We're not going to see anything remotely resembling 2008, but you could see that market conditions addendum to the appraisal coming into play if you're in Phoenix and homes are selling for 100,000 less than what people were asking for. If you're getting $85,000 off a place in Texas, lenders will look at that, and they will be a little bit more conservative if they feel like the trajectory in a local market is down.
Agreed. Okay. Not a lot of questions. So guys, now is the time to ask one. If you have it, we are sitting here ready to go. Josh, side question. Willing asked earlier, Yeti or Stanley?
The funny thing is, Jeb, I wanted to answer the question because this is my guy here. It is neither a Yeti or a Stanley, and I've had it so long, I don't even remember what it is, but it is
That
better.
is a,
do you know which
my
one it
wife
is?
has that one. The cool thing about that one is it doesn't spill.
It doesn't
Like,
spill.
yeah,
The Stanley spills.
you can leave it on the couch.
Hydro jug. Hydro
There you-
jug. I just had to
there
turn
you
it
go.
around. It has a label right on the back of it.
There you go. I don't know. I like Yeti. I've done Arctic. I've never done Stanley. What I've found is when you buy nicer things, you pay a little bit more for money for them. They typically last a little bit longer, and they are what they promise to be. And so Yeti is, I can put ice in this thing, and I come back 12 hours and things still blocks of ice in it. So I'm happy with the Yeti. My wife has done Stanley, so to each his own. Let's see. Josh, this is a good question. I don't know the one we've had before. Are closing costs determined by the value of the home or the amount you're borrowing when buying?
Some of both.
Yep.
Most of your box A fees, lender fees, are going to be a fixed amount: a processing fee, a doc fee, an underwriting fee. Any of that is going to be a fixed cost. In box B, appraisals are pretty wide bands. If you get up, $1 million plus property, you'll pay a little bit more for an appraisal. But box A and B, for the most part, are fixed costs. Box C, where you get into escrow and title, escrow is basically the size of the sale, so the home price. So you could be paying cash. You're still going to pay based off of the 500,000, the 1 million that you're paying for the home. The title insurance, most times the seller is going to pay for the owner's policy to ensure that you are getting clear title to the property. Most times, if you guys are out there buying new construction, most times the builder will put that on you and you get to pay that. But the lender's policy, the policy that you're buying to ensure the lender has clear and marketable title and is willing to make the loan to you, that does vary by your loan size. So the less you put down, the bigger the loan you're getting, the more you're going to pay. So for the most part, really, box A and B are fixed, and box C is variable based off of your loan and sale price.
All right. Rich is asking us a question here, Josh. Rich. It says, how do you identify junk fees on a loan estimate? When comparing lenders, are origination fees the only fees to compare? How do you educate your buyers to negotiate? So, Josh, we've done episodes on this on the Educated Homebuyer podcast, talking about loan estimates in detail. What's the easy answer here?
Easy answer. Look at box A and total up all of the fees. I don't even care what they call them. I've used this example 50 times before. A year or two ago, Jeb, I was looking at a loan estimate that someone had from another lender. It said Encompass technology fee. That's a piece of software that we use. This lender thought that each borrower should pay a proportionate rate of their software that they have to use. And it was $99. And at first I was appalled. I'm like, this is the dumbest thing I've ever heard. And I said, you know what? I truly don't care. Call it anything you want. Discount points, origination fee, application fee, processing fee, underwriting fee, admin fee, doc fee, anything that shows up in box A, just call it points. Don't get hung up on a junk fee. I don't care what it is. That is what the lender has said. I need to be paid to give you this interest rate. So just call it points. This is my rate. These are the points that I'm paying, and compare it to anyone else that you are talking to. And most importantly, I have to say this every time because we have a small portion of the audience who thinks that when it comes time to get a loan, you call 9,000 people and you see who will quote you the rock bottom lowest interest rate. And also 1 or 2 times a week, I get a call from someone crying that that rock bottom lowest interest rate was a bill of goods and everything changed, or the person couldn't deliver, or the person disappeared in the middle of the transaction. So you are shopping for someone who has excellent competitive terms for you, and also the highest levels of knowledge, expertise, and service to make sure you have a smooth and easy process.
And that link at the bottom will get you in touch with Josh and the team, and you can have that smooth, easy process. Brett would love to know your guys' thoughts on a for sale by owner sale without realtors. Is the money savings worth it to just go with an attorney? Is the process much harder? So I have never done a for sale by owner.
Are they selling or buying, Jeb?
It sounds like they're maybe selling and buying. At one point, I know they were buying, but yeah. So can you save money? Yes. Can you lose money? Yes. Can it be a headache? Absolutely. Depending on the state you're in, what's required. The liability is the biggest thing that you need to concern yourself with, and making sure you're not taking on, buyers that aren't going to perform. And now you're dealing with, this whole forcing somebody's hand and trying to make deals happen. It's just, there's a lot that goes into the process. It's not as easy. Most of the time it's just putting a sign in your yard and people coming and making offers. I read an article recently where somebody did, a for sale by owner, and it was kind of the cons against it. They wrote the article, and it was the number of calls that they received from the for sale by owner. Not only was it agents calling them to solicit the business, so their phone was ringing off the hook, it was also buyers calling, and they didn't know how to qualify these people to start with, to figure out if they were even qualified buyers to come in the home. So they were dealing with that piece, and then trying to schedule showing. So it's a lot of the things that you don't think about when you're, selling your house. It's all of the stuff that clients don't see, and other people in the transaction, it's not ever talked about because it just kind of happens behind the scenes, and things run smoothly because of that. But with that said, I mean, there are definitely people out there that can do it and do it successfully. And then there's people out there that 100% should never try it. So it just kind of depends on the person you want to be, right? Are you the kind of person that wants to be a property manager? Are you capable of managing your property, and you like the idea of doing that? Because not that it's the same thing, but I would say it's, if you're not comfortable with that, then you definitely shouldn't be selling your house.
Well, here, Jeb, he followed up with a couple clarifications.
Yeah.
Buying possibly from an old neighbor. So someone that he has a relationship with,
Sure.
They have been talking and trying to buy before she wants to put it on the market, want to entice her to sell to us by saving the realtor commission. Maybe you get some discount. So I think this, when I would say someone should possibly consider it, would be this type of a situation. Sure. It's not, I don't want to pay anyone, I'm going to save money. There's other better ways to do that. And it's been proven that the data shows that realtors will generally get more for the home. But if it's someone that's reasonable, the two of you can come to a meeting of the minds and you have an agreement. I have a listener to the show that I'm talking to tomorrow at 9 a.m. He's buying a property from his landlord, and they agreed, hey, this is the value to the home. So he has a friend who is a realtor who's going to draw up the contract, make sure they have all the disclosures, and I'm sure they'll pay him something for his time or her time. But I think this is a more common situation where people are more likely to consider it. They're not out there necessarily looking for it, but it comes up.
And I think that's okay, right? I mean, but I would still not forego certain things with that contract, right? I mean, you still want to do inspections. You still want to do that sort of thing. As the buyer, you need to make sure that the contract you're signing actually obligates you to be able to buy the house, and that the seller can't back out and that sort of thing, right? Our RPA here in California, for example, I think you're out of state, if I remember, like Colorado or Utah or somewhere. I don't remember exactly. Maybe I could be completely off base. But our contract here really protects the buyer. It's equally protects the seller, the buyer, and the broker, but really it's buyer friendly, very much so, in the sense that once a seller signs, it's very hard to get out of it. And so what you don't want to do is get your hopes up, get into contract, do all of this stuff, and then the seller doesn't decide to sell or whatever else. So just do your work, do your homework. If you have an agent friend, talk to them, see if they can help, kind of walk you through the process, and so that you're dotting the I's, crossing the T's.
Jim,
Yes,
I
sir.
want, I want,
Yep.
yeah,
You want to go
no,
somewhere?
let's go through that one. There's several good questions here. Go through that
Yep.
one.
EC Rico, your thoughts on Long Beach, California market, buy or wait? I think the Long Beach market is a good market. Depending on where you are, the whole buy wait question is tough, right? We go over it all the time. It's whatever's right for you. It's is the market going to appreciate so much in the next 3 to 4 months that if you don't buy now, you're going to pay substantially more in 3 to 4 months? I don't think that's the case. But at the same time, if a good property comes up in one of these markets and it kind of checks the boxes for you and the payments make sense and you got money in the bank and you got a longer term time horizon and all that good stuff, then why wait, right? What is the reason you're waiting? I think if you're waiting for prices to crash, you're waiting for lower interest rates, I think you're waiting for the wrong reasons. And so that's what you have to take into account. Also, different pockets of Long Beach, depending on where you're looking. I think there's some great areas of Long Beach, and there's some areas that I wouldn't buy in Long Beach. So to each his own. Josh, what are your thoughts?
Absolutely. There are some very nice parts of Long Beach where you would be thrilled to live, and there's some very not nice parts of Long Beach where you would be unhappy to live. But yeah, same thing. Is the time right in your life, and are you comfortable making the decision and being there for 5, 6, 7, 10 years? I am quite confident that 10 years from now, home prices will be higher everywhere in the country, even areas like Florida, Louisiana that are struggling. 10 years from now, very confident those prices will be higher. Doesn't mean that if you knew that it was going lower that you jump in and go, hey, it's cool, it's going to be higher in 10 years, but it's just looking at that view. None of us have a crystal ball knowing where prices are next year, where they are 3 years from now, but know yourself, your qualifications, your strength in your job, your finances, and what do you want? What do you value in life? Do you value the flexibility to keep renting and see what happens with the market? Or do you value putting down roots, building up some equity, getting into a home? Pretty much the same as what you said, Jeb. How about this one? This is really a realtor question, and it's not super relevant for us in California. A bit off topic. Joyce says, do heated floors usually appeal to buyers? Do you think they give added value to a house?
Do they add value? I would say no. Do they entice some buyers who were already thinking about the house, and that's maybe something that the other house doesn't have, and it kind of persuades them? Yeah, I think there's a possibility for that. If you were in, Salt Lake City or one of these areas that big ski towns and that sort of thing, and and there's snow on the ground all the time, and I think heated floors are a great idea. Southern California, they would they would do nothing here, right? So it all depends on the market that you're in. But as far as, there are things that sellers think adds value, and then there are things that add value. That's one of those things that, hey, that's nice to have. It's not necessary to have, and it doesn't necessarily impact the bottom line, right? Two houses side by side, one has them, one doesn't, probably going to sell for the same price.
Let me answer it from a different angle. And the
Yep.
angle is that don't think of it in terms of resale value. Does this make my home more desirable? My house is tile except for 2 bedrooms. Everywhere tile. And biggest regret is that we didn't do the heated floors, because that type of heat, the radiant heat from the floors, is so much smoother, consistent, easier to control, and just feels awesome in the winter. And that's for us somewhere where we don't really have a winter. It doesn't get cold, but tile floors are cold even in Huntington Beach winters. My wife, one of her good friends from high school, he built a house up in Washington, 4,000 square feet, wall-to-wall tile with radiant heat flooring, and it's awesome. You roll in, and the house just perfectly toasty and comfortable at all times.
Yeah, and that sort of thing, like if it's an entire house, yeah, I can see where it would add value. I'm thinking primarily like bathrooms, like where people generally do heated flooring. So
Either one, whether you're doing it in a small one or throughout the house, it's a very nice to have feature for you living in it, more so
sure.
than someone else coming and deciding they're going to buy or not buy your house because it has it.
Sammy, do you think buyer demand will return to the SoCal market with lower interest rates later this year? Do you think sellers will have to keep cutting prices at the same rate if this happens? So think about it. If buyer demand returns, would sellers need to cut prices? I think the answer is no. But again, it's all relative, right? Relative in how pricing starts to begin with. I think people get caught up in, hey, there's 37% of the homes out there in the market have some sort of price cut. Okay, where did those 37 percent of the homes, where did they price their homes to begin with? Were they in line with market, or were they, some of them, trying to shoot up a little bit? Is a $3,000 reduction in price really a price reduction? I mean, that's what I start seeing. Like, I saw a property yesterday, they dropped the price $1, and it showed as I'm like, that's not a price cut. Like, you're just doing that to get it back to the top of the feeds on some of these platforms like Zillow and Redfin. It shows a price reduction. Okay, that's not a price reduction. So again, it's relative, but I do think interest rates coming down will help more buyers come to the market. Does it look like it did 3 years ago? I don't think so. I think you will see more activity, but I think a more normal market.
I look at a question like this, Jeb, and just let me give you my response to the question, and then react and tell me what you're thinking or seeing. Do you think buyer demand will return to the SoCal market? So it tells you that it's missing or lacking. It's low. It's low, right? I mean, you just look at the volume of homes selling. It is low, but it's kind of in balance with where supply is, and realizing that California or Southern California. So California as a whole is up about 50% in terms of inventory, still underneath the 2019 levels. But then it says, do you think sellers will have to keep cutting prices? I'm not seeing sellers having to cut prices in most of Southern California, especially in nice homes. I say that there's a home, Jeb, in my neighborhood. I don't know if it's the Bolsa Landing or the Landmark. It's on the wrong side of Talbert. You know, there's a side of Talbert that goes to Seacliff Elementary, and then the other side that's just not as nice. Same builder. And they came on the market. It's a beautiful home. Someone renovated it nicely. And you're like, that is an insane price. You wouldn't get it on the other side. And to their credit, this is a $300,000 price cut. You go, oh my God, it's a $300,000 price cut. Well, it's still $100,000 too high. So I look at it, price cuts are out there happening. What I see is desirable homes are selling, you know, maybe not with multiple offers, but they're selling pretty quickly and pretty near asking price. So it will, I don't think rates coming down are going to cause a spike in demand. It's just enough to kind of keep that floor. I truly think that we still have 2, 3, 4 years ahead of us of a kind of similar market to what we've seen, lower than normal sales volumes. I don't think we're going to see a big price drop. I don't think we're going to see a lot of appreciation, and rates coming down would be the one thing that could change that, but it doesn't mean you get back to 5, 6, 7% appreciation. But what are your thoughts? I think you muted yourself again.
I did. I was drinking water. I didn't want you to have to listen to
I thought
that.
You were tired,
new mic.
tired of our conversation.
Well, not a new mic, an old mic, but because I'm home, I'm here. So guys, I got back from Laughlin today. So if I look like I've been in the desert playing golf for 3 days and I need sleep, the answer is yes, that is exactly how I feel. And
that sounds like a humble brag, Jeb. That sounds like a humble brag.
You know, it rained for 3 days, Josh, in Laughlin. High temperature was like 70, you know, mid 60s most of the time. So it wasn't cold. You could wear shorts, but it was not ideal golfing weather, but it was a good time. So I was happy I was able to go, but I'm very glad that I'm back home. Let's see. A couple good questions here. Mackay is currently on a postdoctoral residency. Current income is way lower than what they will be making. Should I wait until I start making more money to get pre-approved? 55,000 now, 120 when I finish. Josh, what are your thoughts on that?
If you can get what you want and you're happy with $55,000, then do it now. If you need the $120,000 income, there's not a whole huge reason. But what do we talk about here on the show? It's never too early. So if you come to me, we can base it off of a projection of 120,000. If it never comes to be, it never comes to be, and you can't do it. But for most people, that's a pretty substantial difference. Double the income is going to make a big difference in what you can buy. So unless you're comfortable buying at 55,000, if there's a spouse that also makes money and it gets you into what you want, then there's no reason to wait. And there's not a reason to wait to talk to a lender and have a conversation, but you're definitely going to wait to buy because you can have just so much more buying power at that point.
Good stuff. Miguel says, article mentioned that the current foreclosures were in the hundreds of thousands and over 80% of them were FHA loans. How accurate is that, Mr. Lewis?
Well, before you kind of go into the second part of it, there are almost no foreclosures. And when we talk about a foreclosure, a bank took back that home. There are almost none. So the article that you're seeing is there was a Biden era policy that basically kicked the can down the road and gave free modifications to anyone, whether they could even prove that now or at any point in the future, they might have the ability to start making that payment. So you have many FHA borrowers with what's called a partial claim, where they go, oh, you're behind $40,000. We're just going to add it onto your loan, and then someday you'll start paying it back. And some of these people have done it 2 or 3 times. Have been in their homes 4 or 5 years without making a payment or many payments over that time frame. So that is actual and that is real. The total number relative to the size of housing inventory throughout the country is not alarming. But anytime you talk about supply that would be bank owned, if you had a concentration of it in any area, it can certainly distort the market to the downside. So that's why we kind of talk about, if you're a first time buyer and you're in a part of Southwest Florida, for example, where prices are experiencing some pressure, and you can dig into the data and go, hey, I'm in a heavy FHA area, that's just one more risk factor to worry about. On the big picture level, what's happening today, it is not an issue. It is certainly something to watch. The Trump administration has already ended that policy. So what is it? It's still not till the end of the year. What did they give us, like till like September or something, Jeb, before they truly shut it off?
Yeah, I don't remember. I mean, I just saw an article that that foreclosures were actually down month over month or year over year. I mean, so here's the thing: the headline gets the all the notoriety, right? It's that, hey, foreclosures did this, and it's this big thing. Well, what they're doing is it's relative. It's always it's compared to something in the past. So when they're saying foreclosures are up, yeah, they're up, but how much are they up? Like, what is it relative to? And so a lot of the foreclosures that are happening now and have happened since the pandemic are people that were behind on their payments prior to the pandemic. These aren't people that are necessarily behind now. Now, some of them could be, and there are people out there that are going into distressed situations, and properties will foreclose. But I think a lot of people want to compare it to '08, and that prices are going to be cheap and that people are going to be able to pick up these homes for cents on the dollar. And the reality is that's not going to happen. So if that's the idea, I think that's the wrong idea. But again, just know your market, know what's out there, and just kind of play your own, put your own touch on whatever it is you're trying to do, and not just get focused up in the headlines. So. Josh, we got 2 questions here on listing homes. Saw a house listed at 1.56, then relisted to 1.468, then immediately went under contract. I'm guessing they had an offer prior to the decrease, or why not just have a price drop? So what I think is people, and I'm not saying this is you, because it could very well be exactly what happened, but what happens is, like, my wife follows Zillow and all these sites, and so she'll say, hey, I didn't see that house. I don't see that house on the market anymore. And I look it up and I'm like, no, it's still on the market. It's impending, or it's active under contract, or sometimes it's in a hold status, and it just and these websites don't show it. So people automatically think, because I don't see it, it's been removed from the market. And that happens. And so what happens sometimes is people get offers, and say, for example, I listed a home at 1.56 and I got an offer and we accepted it for 1.468. I don't change the price in the MLS. Some agents do. Some agents go in and now change the price to that number at the time they accept an offer. I've never done that. I see it happen all the time. So it could have been one of those situations where they put it in hold, accepted an offer, went in and changed it on the MLS, and now it reflects, this lower price, and now it's under contract. That could have happened. It could have also gone off the market. They lowered the price, and as soon as they lowered the price, somebody made an offer and they accepted it and moved on. So there's you don't know, right? It's understanding the context and what happened is helps in these situations. But unfortunately, there's not like a manual you can read in figuring out, hey, this one did this exactly, without having a conversation with the agent. So I wouldn't worry about it too much personally, but if you wanted to know, just call the agent that's got the listing and ask them what happened, and they'll tell you most times. Trisha, how do you analyze comps? So comps, what is a comp? A comp is a comparable home to the property that you're trying to compare it to. And so let's take, for example, a 3-bedroom, 2-bath home that's 1,500 square feet on a 6,000 square foot lot. And my wife just got part of her Mother's Day gift and smiling at me through the window here. So just Mother's Day's ruined. Anyhow, so what I try to do as somebody like listing a home, I try to go out and try to find comparable homes to that. So 3-bedroom, 2-bath homes. Ideally, I'd love to find the exact same model match in the same neighborhood with similar upgrades, right? That's ideal. But typically speaking, that's not the case. And so you have to go out and, I go 300 square feet on either side of a property. So if a property is 1,500 square feet, I'm looking at comps from 1,200 square feet to 1,800 square feet. I'm looking at both 3 and 4-bedroom homes. And I'm kind of, just looking at different things, location, lot size, upgrades, these sort of things, and kind of backing into numbers based on what other homes have sold for. Because I did a lot of broker price opinions, BPOs, and appraisals for the foreclosures back in the day, I have a pretty good gauge on how to do comps and come up with values just because I had to do so many of them during that period of time. But that's basically what happens is you're trying to do that. Now, as somebody that's not an agent trying to do it, it's more difficult, right? Because you're not 100% sure on some of the things and how to, what's a 3-bedroom versus a 4-bedroom? How much does a pool add versus not a pool? How much is a kid? Some of these things you just kind of have to have experience with. So that's the long and short of it. So hopefully that's helpful. Josh, is spring usually overpriced?
So we've shown the chart, and I actually had it up here an hour or two ago. Wish I had it back down. The majority of appreciation happens in the months of April, May, June, July, kind of into August. So homes that go under contract late February through June and are going to close before people get into school. So that's really the genesis of the question, right, Tricia? Isn't this when most buyers are out? Yeah, that's true. But what doesn't happen is we get to the fall and then home prices drop or they get cheaper or more affordable. So being in the market right now, stepping out and coming back in the future doesn't tell you that home prices are going to be lower. You're just going to be buying homes that are not appreciating off of that new higher value at quite as much. So I don't think you're really solving anything. I think the people who can benefit from this knowledge or knowing this are the ones that in October or November are like, you know what, we're going to wait till spring. Like, okay, if that takes that long to find the right home, wait till spring. But I wouldn't be out of the market at a time when there's less competition and less appreciation. So hopefully that answers your question.
Yeah, I mean, I don't know that you said this directly, but I was kind of reading some stuff as you said it. But the majority of the appreciation happens this time of year, right? So if, you got a $500,000 home and it appreciates 3%, that $500,000 home is now $515,000, which means in the spring or in the fall, that $515,000 house is now $515,000, and maybe you don't get any further appreciation. So it's not that it's overpriced. It's just that time of the year when people are buying, because that's when the majority of the winter markets, when they start to thaw out and people want to get out and start looking at properties, they want to get in before their kids go into the next school year, something that you mentioned in that comment there. I don't think waiting gets you necessarily a better deal most of the time. It's just, can you find the right property that maybe you're not seeing on the market at the moment? Now, if you're in a market like Florida or Texas, Louisiana, where inventory is continuing to increase and that sort of thing, then it could be worth waiting a little bit just to see. But you're in Chicago, and I think that market is still moving fairly well. So I don't know that I don't know that waiting is going to give you a lower price, at least at the moment. Josh, I'm going to answer this one real quick, and then we'll end with one final question. Appraisal came in $15,000 over the purchase price. Is it common for appraisers to use comps from a different zip code, especially if it's bordering a city like Cerritos? So if it's right on the border of a city and a neighborhood makes up kind of, two different cities, if you will, I think it's reasonable to do that. If it's further into the city and they're going way outside of Bellflower, is where I think you said earlier, to find comps, seems crazy to me, because there should be enough homes in Bellflower in order to make that appraisal work. I think most
especially
of the time,
if it came in high, Jeb. Think about this, like in another market where you're like, oh my God, we got to find whatever comp we can to make this work. It's more common to see it then versus if it's 15 high, weren't there other comps? That comp shouldn't have been the deal breaker.
No, agreed. So I don't, it's definitely not common, but can it happen? It definitely can happen. But understand that there's appraisal management companies reviewing these things now, and the lenders reviewing it. So whoever's reviewed it has thought that it was okay. Otherwise, it would have been kicked back, because they would if they didn't feel like those comps were reasonable. So I
Even
don't
to
think
the
there's
point,
anything to
Jeb,
worry
that
about.
there is an automated measurement, a score for that. So when your appraisal comes in, you see it as a PDF, comes into the lender as an XML document. It goes into their system and it kicks out a score. And if that score is low enough, if that confidence level is low enough, they'll call for a review, kick it back, say, I don't like this comp, switch it out. So probably just like Jeb said, nothing there to worry about. It is, they are looked at closely, even if it doesn't seem as though it may be.
Let's give a really easy answer for this one, Josh. How do you calculate income with a 1099 versus a W-2?
You can't calculate income with the 1099 because you know nothing about the business. It's an independent contractor and it says that they were paid that much. So you have to go to their Schedule C. If they're incorporated, go to their 1120, their 1065, whatever their business structure is, and you have to analyze the complete tax return for that self-employed borrower. If you're talking about Fannie, Freddie, FHA, VA, if you want to go non-QM, are there lenders that will lend off of a 1099? Yeah, but you're paying a premium for it.
And here's my advice. Don't try to calculate that on your own. I would say that 90%.
Don't watch a video and try and learn it.
90%. I'm going to go stretch. This is a made up number. 90% of loan officers cannot calculate income off a tax return correctly. And even maybe higher than that.
Jeff,
and even the ones that can calculate it correctly get it wrong sometimes. That's why there's other people involved in order to underwriters to make sure those numbers actually work out.
Jeb, we were at a party in the fall. It's actually a friend of my wife's. He's a very successful loan officer. We're at his $3.5 million house in Newport Beach. And she tells me after the show, you are not going to lose. My wife is a wholesale account executive, so she deals with idiots like me on a daily basis. Says, we were having a conversation. You are not going to believe this. He goes, yeah, like your husband, he knows how to analyze tax return stuff. I don't know. I just take it and I send it over to underwriting and let them figure it out. And this is not, this is someone's done this for 25 years.
This is not uncommon, by the way.
Not uncommon. Successful loan officer. He says out loud, I'm like, if I didn't know how to do it, I wouldn't tell anyone that. I'm not going to run around and pretend like I can, but I'll just keep it to myself that I don't know how to read the tax return.
You know, it's out there. So if you're looking for somebody professional, use that link scrolling the bottom of the screen. If you need help with a real estate agent, I can help you personally if you're here locally. If not, can refer you to somebody that can guide you through that process. If you're finding any value, do us a favor, hit that thumbs up, share us with other people who might be looking to buy a home. Until next week, make sure you're buying right, borrowing smart, building wealth. Adios.
Amigos.